Okay. So yes, good morning. As we know, 2020 was quite the year, and it brought a lot of chaos, and with that comes a lot of questions. As we prepare for this tax season with all the different resources that were out there for supplement income and just a lot of questions floating around the air. So we have Jeff Hood and Jaime Pugh with us from MNP. They are both partners there and both business advisors who are well equipped in working with small and medium-sized businesses. So Jeff and Jaime, I'll maybe let you two kind of talk a little more about what your role is within MNP, and then we'll jump into the presentation. And feel free, everybody, to utilize the chat box feature down below for all our questions, as at the end of this, we will have a Q&A period where we can answer all the questions that have been asked. So I'll let you two take it away.
I'm Jeff Hood. My role here is basically small and medium enterprise type businesses like you guys. Lots of taxation, lots of dealings in the government programs over the last little bit. So hopefully, yeah, we can kind of clear up today, just refreshing a little bit on what's actually still out there, because there's still lots out there, and I know talking to clients that I have, that it's almost a surprise that stuff is still out there and then they actually qualify. So we'll go through some of that, as well as looking at when tax returns come in, just some of the changes for personal tax returns, corporate tax returns, and T4s that have come into play for you guys as business owners to consider.
Hi, I'm Jaime Pugh. I work with small to medium-sized commercial businesses as well, and do personal tax planning and retirement planning. So basically, the point of today is we really just want to revisit some of the programs and some of the changes that are going on, because it seems like changes are continually happening. And from what we've been hearing from the government, they're having to move things around, as everything was not necessarily rolled out as clearly as what they were intending to do in the first place. So it's going to be kind of a high level situation discussion here, because of course every business will be different. So definitely feel free to throw out comments in the chats or any specific questions you have. We'll do our best to respond to that, because I certainly know this has been a hard time for everyone, and if we can make it a little bit easier, we certainly want to. So we'll maybe get started with the show.
Pardon me for a second. All right. What heard of that? Yeah, how
Can you go to start slideshow?
yeah, where is it?
Should be at the top.
I know.
Sorry, we're not the most IT savvy people. We're accountants,
Click the little
not
button
IT.
in the bottom, you guys, by the Zoom feature there. Yep.
You have to go to
Over.
Yeah.
That one.
Oh, thanks. Sorry about that. Woo. All right, good thing we're not teaching about that today. So we'll start off talking about T4s and taxable benefits and the things that have changed because of COVID-19. So these are everything that's going on this year, the 2020 year for employees. And a lot of it is more just so that you're aware, so you can talk to your employees about some of these changes. Commuting costs have changed. I think this is made more for larger centers, but it's definitely something to be aware of. So basically, if you reimburse your employees or pay your employees for commuting costs, and they decide that for their safety, they want to change their commuting costs, which have increased. So for example, if they would normally take the subway to get to work and now they're wanting to take their personal vehicle, these things are deemed to be non-taxable this year because they're, of course, we're trying to ensure everyone's safety. The other thing is if you were working from home this year and you have to go back and forth to work to get things to enable yourself to work, that would also not deem to be taxable this year. It is important to always tell your staff to maintain a log of their travel so that if CRA ever came back and questioned everything, they've got backup for that. Employer provided parking. So if you pay your employee for their parking spot or reimburse them, when COVID shut down all forms of businesses, people were still having their parking spots paid for. This would not deem to be taxable for that period. Once everything was reopened and people were back to work and parking again, it would flip back into a taxable benefit. So computer and home office equipment, basically when the shutdown happened so quickly, a lot of people weren't set up at home to be able to perform their duties. So what CRA has allowed is that it will reimburse, it will allow a company to reimburse or pay their employees up to $500 for things like computers, printers, those sorts of things. And that won't be a taxable benefit. Anything that is over the $500 though would be deemed to be a taxable benefit and would be included in their income. It's also important that the receipts be provided to the employer for a backup trail. Meal costs. So basically, if you provide meals to your employees during their regular work hours at their regular place of employment, this is deemed to be a taxable benefit. There are circumstances that are not deemed to be a taxable benefit, and this would be if you provided a meal for someone working overtime or you subsidize a meal. So an example of that would be if you had an employee cafeteria and they paid $10 for a meal, but it would be charged $15 somewhere else. They're saying that because they paid a reasonable rate for that meal, it would not be deemed to be a taxable benefit. The other thing about overtime is you have to be cautious of what is deemed to be overtime. So if your employee works 2 hours either before their shift or after their shift and you provide them a meal, that would not be a taxable benefit. But if this is something that is expected every day or 3 times a week for the whole year, that's not really deemed to be an overtime type meal, and so that would be taxable. So it's kind of a gray area, and it's good to reach out if you're unsure. Cell phone and internet services. An employer can pay for or reimburse an employee for the cost of their cell phone plan or their internet service at home due to everyone having to work from home for this COVID-19 period. Another big change this year was for the automobile standby charge and operating expenses, and this is a pretty big one. What they were finding is that if a car is provided to an employee, a business car, typically they would maintain a log, and at the end of the year they would get a taxable benefit for their personal use portion of that vehicle. So the problem that happened this year is when everything shut down, people were not driving their business vehicles for the same amount that they were in prior years. And it worked out that their standby charge and operating benefit were substantially larger because the majority of their kilometers would have been personal kilometers. So CRA realized, you know, this is kind of a one-off, we're all in the same boat here. So what they're allowing is for employees to use their 2019 rates to use on their 2020 and 2021 T4 for their taxable benefit. So that is both for the 2020 year and 2021, which is really important to keep in mind. That way then employees are not getting charged substantially more income because of their personal use of the vehicle. Now this T4 information reporting changed quite a bit this year. And the frustrating part is it has created a lot more work for anyone that prepares T4s. And this applies to everyone, whether you received government funding or did not. Your T4s are required to be completed this way. So what happens is normally in box 14, you've got your employment income in there. But what CRA is doing is they've added in a box 57 to 60. And what that has done is it's showing the employment income that was paid during those periods. So you can see on the slide here for code 57 is March 15th to May 9th, and 58 goes May 10th to July 4th, etc. So what they're doing here is they're trying to figure out if someone had claimed CERB when they shouldn't have. So this is CRA's way of basically they can run a quick test with their computer, pull out anyone that had employment income in that period and match it to see if they've received CERB in that period, and then basically require either a repayment or they have correctly done it. So those boxes are also already included in box 14, but it's really CRA's way of finding the people that have received CERB that shouldn't have. It's a lot of extra work for people, but unfortunately this was the easiest way that I think CRA could have managed to find all the additional money that had been paid out. Oh, I was just going to mention, sorry, with the taxable benefit about the vehicles, I forgot to mention that you did have to have a car in 2019, of course, to qualify for that. All right, so the next thing that I think that was rolled out that caused some confusion was the CERB. So when self-employed individuals were able to apply for the CERB if they had $5,000 worth of income in the 2019 period, but it wasn't really clear if it was net income or gross income. So CRA acknowledges the fact that it was not specific to say net income. So if you had applied for the CERB and received it and had $5,000 worth of gross income, a lot of people have already repaid that thinking they didn't qualify. Since the government has realized the confusion there, they're basically saying, no, this was our error for not being clear. You can keep the CERB for those periods, and anyone that has repaid it will be refunded. Interest relief. For the 2020 tax filing year, there has been no extension to it. But what they're realizing is that a lot of people have received government funding that wasn't necessarily tax deducted. So there's going to be a lot of unexpected tax owing on April 30th of 2021, and people might not necessarily have all the money on hand to cover that. So what they've allowed for is an extension to repay your tax by April 30th, 2022. So basically giving you a full year to have the opportunity to repay any amount owing. In order to qualify, you have to have taxable income of $75,000 or less, and you had to have received income support through one of these items listed. The other thing, typically in the past, if you had received a GST payment or a Canada Child Benefit payment, they would apply it if you had tax owing to that tax balance. For this year, they will not be doing that. And as I stated before, the tax filing deadline has not been extended this year, and there's not really been any discussion of extending it. So I would be sure to get your taxes filed by April 30th to ensure you don't have any penalties. So the other thing that rolled out this year because of COVID was home office. So they understand that employees were forced to work from home. And so they're allowing for people to have a deduction where in the past a T4 employee was not able to deduct their home office. So the criteria to be able to deduct your home office is that you had to work from home more than 50% of the time over at least a 4-week consecutive period because of COVID. Of course, for many of us, that period was substantially longer, but that is the criteria to be able to qualify. So they've allotted two different ways that you're able to calculate your home office deduction. The first way is the simplified method, and it's basically $2 a day for every day that you worked at home in that period and any periods past the 4-week minimum. And the maximum amount of that deduction is $400. There is no requirement from your employer to get a T2200, which is basically the declaration that you are forced to work from home. That is not required for the simplified method. The detailed method, you do have to have a T2200, or there's a T2200S, which is created just for COVID, that your employer has to complete. And basically here, you're going to keep track of all of your expenses and do the deduction based on the actual amount spent, based on the square footage of your home office and those sorts of things. So it's a much more detailed calculation. Plus, you also have to maintain all of your receipts, as things like this are commonly audited, and they usually do ask to see for receipts. You cannot claim any expenses that were reimbursed by your employer either. When we've done some of the practice calculations just to see, for some of our staff members, the $2 a day actually works out to be more than what their detailed method is. And so keep that in mind when you're determining if you want to keep all your receipts, track everything. Sometimes the simplified method is the easier way to go. So some of the things that you're able to deduct, if you're a salaried or a commission employee, you can deduct electricity, heat, water, so basically all of your utilities as a form of percentage. When it talks about your condo fees, those are basically if you live in a condo group that the utilities and everything are paid by the condo group, and then you pay your fees towards that, you're able to deduct a portion of that. Your home internet access fee, minor repairs and maintenance like light bulbs, things like that, and rent paid for a house or apartment. And commission employees can also deduct home insurance, property tax, cell phone, fax machines, those sorts of things. What can't be claimed is your mortgage interest, your principal payments on your mortgage, your original internet connection fee cannot be deducted, furniture, capital expenses, like if you're replacing your furnace, probably not recommended to deduct, and wall decorations. So their intention with all of this is to try and help people who had a disruption in their day-to-day working because of COVID-19. So that's the quick and dirty of the changes going on with T4 processing and things that your employees have. And you know, it's not a bad idea to share some of that with them. I'm sure they would be appreciative to know that there is some deductions out there for moving and working from home. So we'll switch over to review some of the government programs. We're not going into great detail here because we kind of went through all that in our first presentation. So feel free to go back to there because a lot of the programs are still open and available to access funding for, and it's definitely worthwhile looking into. So I'll pass it over to Jeff.
Whee! All right. Yeah, so as Jamie was saying, is for many of you, you might have been on the call beforehand that we did in November, just going through some of the programs that are out there. So we're just going to do a bit of a highlight and hopefully jog some memory, or perhaps at least it gives you an idea of something that might be out there that might benefit your business. One of the biggest ones that we're seeing right now is the temporary wage subsidy. So that was the program that first came out before anyone knows how much of a disaster this was actually going to be. But that one is the 10% of employee remuneration up to $1,375 per employee and $25,000 per employer. This is based on money being paid to employees from March 18th to June 19th, 2020. So many of you probably would have actually qualified for the Qs or SUs payments. However, we're finding that there's lots of business that did not, or they only qualify for certain periods of SUs within that March 18th to June 19th timeframe. So they actually may qualify for this subsidy that is available to many people that are out there. To do this, right? Some people may have actually already taken it off of their employees, sorry, off their payroll remittance. But if you haven't, you're able to file a form called a PD-27 for each payroll account that you actually have, and be able to make this claim. You can either reduce the remittances, or you can actually ask for the cash to be paid right out to you. So yes, the paperwork is the form PD-27 for each payroll account that you have, and it must actually be filed separate from your T4. So it's not part of your T4 process. It's a separate form that actually needs to be filled out. Employers that weren't involved with the CEWS program and do not want to claim the TWS do not need to file a PD-27. And of course, with CRA, if you do it wrong, then there could be issues. So make sure you understand what you're filling out, the programs, or have a professional help you or file the forms for you. So the eligible entities are, if you are an individual or a sole proprietor, a partnership, a not-for-profit, a registered charity, or a small business known as a Canadian-controlled private corporation that would have been eligible for the small business deduction for their last tax year ending before March 18th, 2020. So to speak in technical geeky accounting terms for a minute, if you did not pay the 9% small business tax, which would mean your taxable capital is over $15 million, that essentially kind of pushes you from a small to medium enterprise into a large business, and you wouldn't have been able to claim this deduction. So really, this one is actually for small to medium businesses specifically, whereas the wage subsidy is more targeted towards all businesses, small and large. All right, so at this point, for people, what we're recommending for them to do is actually file this form. You have the option to actually take this off of your payroll remittance. You would continue to withhold tax, kind of CPP and EI from your employee as you normally do. Once you add up and figure out what you actually owe for that period, you would be able to reduce the remittance by the amount of wage subsidy that temporary wage subsidy you'd actually be eligible for. Personally, with the clients that I have, I'm actually just asking that it be refunded, because it saves a whole lot of confusion when you start doing T4s next year, right? Because now we're into the next T4 period, which causes a whole lot of confusion. So the CEBA loan, I think last time we came on, they were just trying to revamp this. Sorry, the loan will now increase from $40,000 to $60,000. If you've applied for $40,000, you can apply for this additional financing as well. You'll automatically be approved. The repayment of this is on or before December 31st, 2022 for the forgivable portion of the loan, which would now increase from $10,000 to $20,000 of the $60,000 loan. Right. So if you've applied for both loans, you'll have to pay $40,000 back before 2022. The question I get a lot is that people want to start paying this loan. There's some people out there that maybe that qualified and they determined that they don't necessarily need it. My personal opinion is that I don't think anyone really knows where this is going. So if someone's going to give you a loan and not require you to repay it right away, my first instinct is usually to hold on to that as long as you can until you have a better idea of where this is going, because you've got almost 2 years before it's required to be repaid. Right, so very similar rules. If you're a sole proprietor with a business number, a CCPC that was operating in March, you can apply for this. And the deadline now for this full application is March 31st, 2021, which has already been extended. And I would assume, you know, we've had a lot of extensions with these programs. There's been no indication of CEWS going on past June or this being extended again. So if you haven't applied for this, or you haven't applied for the additional $20,000, my suggestion would be that you get that loan, you get that application process going. And then you actually must apply for the loan at the same institution that you applied for the secondary loan for the first, as you did for the first loan application. All right, so now there's two streams that you can apply for this. The first one was the employment income paid based on your T4 summary in 2019 between $20,000 and $1.5 million, or the non-deferrable expense stream. This is for businesses that have less than $20,000 in employment income, but they have expenses that obviously are continuing to be run within the business. So you will see this with companies, corporations that are using a dividend model to pay the shareholders and or owners, or a small business who is a sole proprietor that doesn't have any other employees but still has expenses that this program is designed to assist with. So you had to have a CRA business number effective in March 2020. You have to have an active business checking account at the time of the application, and you tend to continue to operate or resume your operations to be able to apply for this loan. As for everyone, if you fall within the non-deferrable expenses, you have to be able to show that you have non-deferrable expenses between $40,000 and $1.5 million over the course of the next period of time, which they haven't really set out the period of time, but I think I'd say within the foreseeable future. So items such as property taxes, utilities, insurance, arm's length wages are all very key items that go into making sure that you qualify for this type of loan. Also within the non-deferrable expense stream, you have to file an income tax return ending in 2019 or have at least submitted 2018s. Oops, sorry. I'm just fixing my. So non-deferrable expenses are considered to be non-deferrable if they incurred in January or February already, right? So it's not necessarily a new stream of expenses, and are due to a legal or contractual obligation that as at March 1st, 2020, and cannot be avoided or deferred, even during a period of shutdown and depressed revenues as a result of COVID. Right, so those expenses that we talked about on the previous screen, insurance, utilities, taxes, right? There's some breaks that are being given, but they're still due. Rent would be another one, which comes into place. Right, items that you still need to pay are what's going to fall into the non-deferrable side of things. All right, so here's a further list of examples that I'm not going to read because I've gone through a chunk of these already, but I'll give you a second just to peruse the screen and have a quick look to see if see what qualifies.
One of the things for insurance, if you paid it all, in December for the year, CRA would take into consideration what the monthly payment would have been, so that would qualify as a non-deferred expense.
Yeah, so yeah, often property taxes are like that too. So yeah, there might be a bit of accounting work that has to be done to determine that, but probably something for you guys to be able to consider.
Jeff, just before we move on from SEBA, we did have a question come from a member, if that's all right. It says, what if you switch financial institutions between the first SEBA application and the second top up?
I think based on what we're reading, you still need to go with the initial institution. Honestly, I haven't seen that. I understand that is something that's going to happen, but I think you'd have to work between your two financial institutions as they're the ones that are administering this program. Did they allow for the CEBA loan in the first application to be moved to the new institution? Right, that would kind of probably be the main question. I'm guessing if the answer to that is yes, that you may actually have to apply for the loan at the original institution and have them transfer it for a second time. This is, you know, with some of the wage subsidy stuff, right, as accountants, we see more of that. The banks are the ones who administer the CEBA loans, right? So we don't see a lot of that application process. We're kind of just seeing it at a high level and ensuring that people are applying for it because it's out there. Right, so with the CEBA loan, each qualifying business must have a unique 9-digit CRA business number and is limited to one loan. So if you know, there are people that have more than one business or one entity that may qualify, so that you're actually able to apply for the CEBA loan in each of those entities. We talked a little bit about this last time too. The forgivable portion of the loan is actually recorded in income in the year that you receive the money. So many people would have received that the first $40,000 in 2020. So on your 2020 tax return, if you'd received this loan, then 10,000 of that becomes taxable. If you're not able to repay that loan, then it becomes a deduction in the year 2022 to deduct against income if it's determined that you cannot repay that loan. Right, so if you're not able to repay all of that loan, it flips to a 5% per year interest only loan starting in 2023, and interest or only payments until the full amount is due December 31st, 2025. And as I just discussed, your financial institution or your credit union is dealing with a lot more of these. So, all right, some of those semantic and administrative questions. So they're probably the best place to start to look at that. Any other questions on CEBA, Erin, before we go on? I don't have the chat up.
Yeah, not CEBA. There is a few other questions, but I'm following along on your presentation here. And I see we just have a few more slides to cover, and then the questions kind of go to earlier things. So I'll come back to those.
Sure. So just a quick update on the wage subsidy. So now periods 1 to 5 are closed, right? So if you haven't applied for that, we're not able to go back and claim for those periods. Period 6, I will say, because I just looked this up, is due on February 25th. That is from August the 2nd to August the 29th. So right, we're not that far away from that. So if you're planning on continuing to apply for the CEWS 2.0, then just make sure that you're on top of that over the next little bit. And as we go forward till the end, till June 2021, the deadline to apply for these periods is 180 days. So all right, so we had a big rush as of January 31st, and that's when they started closing these periods off. Now they're going to be closing them off as we go along, just like any other tax filing that we end up seeing. So the thing to remember with CEWS 2.0, which actually started in period 5 and is going forward, is that there's no minimum revenue decline like there was in CEWS 1.0 with a 30% decrease in revenue required to be able to apply for these periods. So the maximum subsidy for periods 8 to 10 is going to remain at 65%, with a base of 40% plus a 25% top if you were forced to close down. Clean periods 11 through 13, the maximum top-up rate is now going to be 35%. That makes the maximum subsidy amount for employees on leave with pay is $595. And the base revenue drop comparison months for period 11 will be the same as period 10. So just a bit on the commercial rent the Canadian Emergency Rent Subsidies, which started as of September 27, 2020, and is going to run until June 2021. The periods coincide directly with the wage subsidy period. So if you're looking at, if you're doing a wage subsidy, then and you qualify for a wage subsidy, you're going to qualify for the rent subsidy as well, most likely. So to meet the qualifications for this subsidy, you had to have a CRA business number as of September 27, 2020, or you had to have a payroll account as of March 15, 2020, or you purchased the business assets of another person or partnership who meets the condition above and have made an election under a special asset acquisition rule, which is good if you're purchasing something, isn't good if you've started a business over this period of time, unfortunately. Same with the wage subsidy. You've got now have 180 days from the end of the claim period to be able to apply for this. Right, so qualifying property includes land or buildings that you use to run your business, your normal course of business. Does not include a home or a cottage or other residence used by you, family members, or non-arm's length persons. Even though you may use a home office that in the normal course of your business, it wouldn't qualify for this type of subsidy. You cannot include any properties where you're earning rental income, or the primary purpose is to use rental income. So if you have a property where you're the main tenant, but you may rent a basement suite or a smaller portion as almost supplemental revenue, there's a good chance that you will qualify for that. But right, you probably want to discuss that with your tax advisor just to make sure that it lines up. Right, and there's lots of rules around the non-arm's length party. So I'm going to come back to this in a minute, but if you're a corporation that rents, a corporation or an individual renting to a business owned by you or a family member, that would be considered a non-arm's length transaction, and CRA has indicated that they're specific to the rental side of things, that won't be allowed. For the larger businesses, you can claim up to a maximum of $75,000 per location, and $300,000 in total for all locations for the program. So as you would expect, eligible expenses if you rent are the base amount and or the rent paid based on a percentage of sales or profit. All right, so if you're in a mall, or if you have that kind of arrangement going on, as well as any amounts that you would have paid for insurance, utilities, property taxes, common area costs, maintenance, often known as triple net lease factors within the course of your rental agreement. Non-eligible expenses are your taxes, damages or damage deposits, interest and penalties, tenant insurance, and any leasehold improvements that you may have incurred. Right, so if you have a tenant inducement, or if you have that included in your rent, right? So if the landlord has done rent, done improvements for you, and you're paying back with your rent, right? Most likely you're not going to qualify for that additional amount above the base that you would need to pay. Now, one thing to consider is if you actually own a property, you can apply for this and be able to get back a portion of property taxes, insurance, and as well as interest on a mortgage. Non-eligible expenses if you own your property are payments made outside the claim period, obviously, right? So we can't go back before September 27th or after June 2021 at this point. Anyway, they talk a lot about the payments between non-arm's length parties, but if there are structures out there where you have an operating company that pays rent to a holding company, so on the surface it looks like you're not able to be able to claim any of this subsidy for those type of payments. However, there are elections that can be filed to look at whether you take it on in a consolidated approach between the two companies and all other non-arm's length parties that are involved within that non-arm's length family group. So if you have that situation maybe don't say no to it right away, but it might be something that you look to talk to a tax advisor to see if that would actually work for you, because it becomes very common at the end of the day that for other business reasons you don't have your building that you're operating in the same company that you actually operate out of. So with that, Jamie's kicking me out of the way. You can't see it, but she is actually kicking me. And so she wants to take over again and talk about something. So I'll turn that back over to you. It's like I'm not even here. And then we'll turn it over to any questions that are out there.
I was just going to mention just a couple of things for the temporary wage subsidy. The deduction, you hold back the taxes, not CPP and EI. So be very cautious of that. And the other thing that I wanted to bring up was in regards to if you have any concerns about these programs or questions or feel like things have not been fair to your business, I think it's a really good idea to reach out to the chamber, because I feel like the amount of having one group go together on everyone's behalf has actually forced the government to implement some of these changes and bring things in that have actually been better for individual businesses. So please keep that in mind to reach out to the chamber in regards to any concerns or questions that you have. All right, questions.
I have to apologize. I did miss a SEBA question when that was brought up there. It says, is the SEBA loan considered income?
So the forgivable portion of the SEBA loan is income, right? So on the first go round, the plan is that 10,000 of the 40,000 is forgivable. So that will come into income, your taxable income in the year that you receive that. And then for the secondary part, 10,000 of the $20,000 is forgivable. So when you receive that loan, that will become taxable in the year that you receive that as well. So the full amount, right? So essentially 20 of the $60,000 becomes taxable. Does that answer the question?
And we have another one that says, a BU student with an at-home office, would this be a legit expense?
So they don't have any earned income? The point of the home office deduction is to offset against earned income. So you need to be able to have that office to help you bring in income. So if there's no income, the deduction would not be available.
If you were working while going to school, then right, you'd have to look into that. But yeah, it's specific to the situation.
So I will say we want to be very cautious how we answer some of these questions, because if we don't know the whole situation, we might not be giving you the appropriate answer. So definitely reach out to us if you want a more specific answer.
Hate the light in the background. So bothersome. There we go. Okay. No, that still sucks.
So if there's any further questions, please use the chat box and we can hopefully get those answered for you here. Let me just scroll and make sure that everything has been answered that I see.
Jeff and Jamie, what's the most common question that you're getting these days with all these funding programs from your clients? Maybe you could touch on that.
I get a lot of questions about the wage subsidy and how you qualify, and if you qualify, how it's taxed.
It's the most complicated of all the programs. Am I wrong in saying that?
No.
Yeah. Yeah. I remember when you guys were describing it back in the fall, and I completely was like, no, I don't get it.
There were so many slides, and it was 1.0, 2.0, and I felt like it was constantly changing at the time. So it was hard to kind of pinpoint what was the right thing to do.
Mm-hmm. And maybe if you guys have like, oh, sorry, go ahead, Jeff.
I was just going to say, it's not even so much questions. I think it's I'm actually shocked at how many people either don't think they qualify for something, or don't want to, right? Don't want the hassle, don't want the risk, and that's fine. Everyone's got their own choices as to how they want to deal with things, but I think it's before someone says no, I don't need the money, or I don't necessarily think I qualify. I think it's just important to be able, or at least somewhat educated about what they may or may not qualify, and what they may be leaving on the table before they completely say no.
And I think there has been fear of, if I apply for this, does that going to open up my whole company to audit? And I think CRA is looking at the specific programs and making sure you have backup and did proper filings for the specific programs, but you shouldn't operate in fear and miss out on an opportunity, because unfortunately we don't know what the future is going to look like, and we don't know if these programs are going to be available going forward. So I think it's important to definitely look in to see if it's worthwhile doing.
I think case in point of that is the stuff that Jamie talked about with the CERB, right? The CERB went out as a complete disaster. We all know that there's many people who got money for that likely didn't qualify. And obviously they've reduced a lot of their initial thoughts on how they're going to penalize, or how they're going to chase that money down. I think we can all say what we want about the government. It's not a perfect system at all, but there's a lot of money going out, and a lot, especially with small business. If it's money here and there, small business is the backbone of the economy. So I think you're going to see. My prediction would be it's auditing is expensive. So for them to go and invest a whole bunch in small business, especially if you are above board and you are legit and you're doing things properly, and keeping good records, your fear of having to pay something back should hopefully be mitigated, right? And it should go down. That's not to say that they won't come and ask questions, or they won't ask for you to provide documentation to make sure that you're qualifying for it properly. But if you're doing things properly and you're falling within the guidelines and you're seeking the right advice, right, there's money there that is going to help you, because we don't know where this is going. We still don't know, right? There's lots.
But that might be part of the problem, is the amount of uncertainty, right? So just going back, and I do agree with you on applying for whatever you can apply for. I did put up into the chat there, it's Innovation Canada. So it's actually a portal where you can kind of pop in all your information, and it will actually suggest what funding is applicable for your business. So we do get a lot of calls, and I'm always happy to help answer questions on that, but definitely use that as a tool, and it works on provincial and federal levels. So I put it up in the chat. So if you guys have any questions about specific funding, and then also a link to our COVID tools and resources, because every funding that we back and support that are legit, we put onto that COVID page as well. So just two little tools there on what you guys were saying.
I was just going to mention too, I think when the programs first came out, the government put out a big thing that said that they were going to be huge penalties and interest if you improperly filed. And then I think they started to realize that the programs were very overwhelming and confusing. And so if you have applied and incorrectly applied out of an honest error, they're not going to put you in jail and shut you down. You're going to end up just repaying that money. But keep that in mind. Again, we say, like, fear should not be a reason for not applying for these programs.
Mm-hmm. And then just as we're at the top of the hour here, what would be your key suggestions or advice that you would give to small businesses through tax time? Like the number one thing that businesses should look at doing or procuring, or what's your top advice?
One thing I find, if you're staying on top of your record keeping, it releases a lot of your stress, because number one, you know where you're at financially. You're able to apply for these things, these programs that are becoming at a lower cost to you because you're on top of your record keeping. And just having a general idea of where you are financially kind of gives you a little bit of peace of mind, being able to sleep at night, knowing what decisions you need to make going forward. So that would be, I think, definitely record keeping would be top of mind.
To pick back a little bit on that, the big thing is, right, be compliant, right? I know we can agree or disagree with how governments operate in deadlines and whatnot. we take it back to the fear of not applying for programs because there's a fear of audit. Your biggest risk for being audited is to not file something on time. Right, that's the easiest thing for the flags to start going up is not filing something, not making payments on time. So right, there's a reason to do that, and CRA will take the easy way out. They will look for the easy low hanging fruit. So if they think that you're non-compliant, then they're automatically most likely going to think that you're doing something else that you shouldn't be doing. So right, if you're applying for you're applying for these programs, and lots of clients I've talked to have that I don't want to have to pay this back. I don't want to have a full blown audit. Then just make sure you're on top of your records, getting them into your providers in a timely manner, and making sure that things get filed on time.
I'm surprised you didn't say the number one best piece of advice is to use professionals to help do your taxes. I'm surprised, but that's okay.
I think that's a given, isn't it?
We said this wasn't a sales situation.
Exactly. Yes.
Yeah. No. Thank you.
I don't want to get in trouble from you guys.
So just wanted to say thank you to everyone for coming out, because I know this is it's a lot to take in and not the most exciting of presentations.
Jamie, it's very exciting.
Well, it's exciting to us, but we definitely appreciate everyone coming out, and stay strong and shop local.
And
Yeah.
big thank you. Oh, go ahead there, Jeff.
No, I was just going to say it's great that the chamber is putting these things on, and always good to see members supporting these type of events, whether it's us or other Zoom conferences that are going on. I just think it's important that we're educated and we're informed, and we know what we're doing and supporting our local businesses.
We have lots of comments in just saying thank you to you guys. Great information, very informative. So thank you, Jeff and Jamie, for spending the morning with us and doing this for our members. If anybody has any further questions, don't hesitate to reach out. This will be sent out to everybody who is registered for this morning. So if there's anything you kind of want to look back on and get some more clarity, you will be able to do that. And thank you everybody for joining us.
And congrats to MNP for your thing with Deloitte, your acquisition.
Oh, thanks.
Very exciting.
Yeah.
That's huge for Brandon, a Brandon-based business. That's awesome. So
it doesn't have a major effect here, but right now, but I think over the course of time, it's right. Just adding those services and people across the country, right? It's just, we're very broad. We use the whole country for our resources. So it just adds more tools to our tool belt.
yeah,
It's
it's
pretty
awesome.
cool that it started here.
Yeah, absolutely.
Cool.
Totally excited for you guys. So way to go. All right.
All right. If
Okay, guys,
there's
have a
no
good day.
further questions, I think we'll call it a morning, and thank you everybody for joining.
Thanks.
Thanks so much.
Enjoy the rest of your day.